Hey everybody, it's Bob the Bald Guy again with your tip of the day. Here we go. We're going to dive a little bit deeper into the concept of gap insurance. We've talked a lot about that. I do have a bunch of videos on my YouTube channel, Bob the Bald Guy. But we're going to dive a little bit deeper into the metrics of it, the math of it, and that this way you understand exactly what it does and what it won't do. So here we go. So gap insurance, as well as you know, covers you in the event that you have an accident with the car is a total loss, and you still owe X amount on the vehicle. The gap insurance is supposed to pick up the difference between what you owe on the loan versus what the value is of the car when the car is totaled. However, what a lot of people don't know is that it may not cover what you still owe on the vehicle, and that has a lot to do with the starting point of when you started to do the gap insurance. So in other words, let's take, for example, if you came into the dealership and you were trading in a car that had a balance still on a loan, and you were upside down on that loan, and you trade that car in, that negative equity forwards onto the new car. You're still paying for the upside down amount of money that you still owed on the old car, and it's put into the new car. So what happens is that actually increases the balance of what you owe the bank in the event that you have an accident. So we're going to take a scenario, and I'm going to post this actually on the video. You're going to see this. So for example, if you have an accident, they total your car, and you have a $25,000 balance on the loan of that vehicle, and the insurance company comes back and says the value of that vehicle is $15,000, there is a difference or negative equity of $10,000 that you still owe the bank. Let's stop right there. Now, this is how an insurance company and or the bank will determine if the gap will kick in and pay for whatever the balance is owed. A typical gap company will pay 140% of the value of the vehicle. The calculation is this, and you'll see it in the sheet again as I post it up now. $15,000, that's what the difference is. I'm sorry, scratch that. $15,000 is the vehicle value. That is what the insurance company has determined is the value of the vehicle. Now, you are now $10,000 difference of what you still owe the bank. Here's how they come up with the calculation. The vehicle value of $15,000 times 1.40, that's 140%. 15,000 times 1.40 equals $21,000. That is what is allocated or available to pay that negative equity. In this particular case, as you can see, you have quite enough money to cover the negative equity of the car, which is $10,000. So that's the calculation that you have to understand, is that gap coverage, for the most part, most companies that are out there will pay about 140% of the value of the vehicle. They call it loan to value. So 140% of the loan to value of the car, that's what Gap will spend. Now, in association with that, what Gap does not cover, in the event that you break the law, meaning you are fleeing from police, you rob a bank, you crash your car, Gap will not cover you. If you are caught on a DWI, Gap will not cover you. it is a worthless piece of paper at that point. Now, with all being said and done, here's some ways that you can get more equity into the car. And I've mentioned this prior on some different videos, is that always try to overpay the loan. If your payment is $400, pay $450 or $425. That little amount goes toward equity. What happens is it goes off the back end of the loan, but it's putting more value back in the car. So it's a little trick. And it's a big helpful trick if you can do it. Even it's only $5 or $10, whatever you can throw at it every month, do it. That will help exponentially. So I'm Bob the Bald Guy. That was your tip of the day. We dove a little bit deeper into gap insurance. I have another series on gap insurance about refunds that we'll get to at a later time. Peace, love, laugh a little. We'll talk to you soon.